What's up everybody, Nate here, and the IRS just made some huge changes to the tax code in the United States. Now, I know taxes are a little bit of a touchy subject because, hey, who wants to pay more taxes? But this year, these changes are actually pretty decent.
Not bad for a little furball.
That's right, this time around, the IRS is making it a little bit easier on the vast majority of Americans, and you might end up paying a whole lot less in taxes in 2023 and beyond. Now, these new tax changes affect your income. They affect your capital gains through your investments. They affect your estate and everything else when it comes to your money. And today we're going to talk about all of them. We're going to break down why exactly the IRS is making these big changes and what exactly all of this means for you and our economy in 2023. All right, so now the first thing you need to understand about these new big tax changes from the IRS is that for the most part, the IRS is actually moving up the chains a little bit. So what I mean by that is that the IRS is actually lifting or raising the amount that you have to earn or the amount that you have to have in investments in order for those things to be taxed. So the brackets are essentially increasing. Like the standard deduction is up from around $12,500 to now well over $13,000. In addition, when it comes to your big income tax brackets, the IRS is actually boosting most of those brackets up by around 7%. So you now have to earn a whole lot more, like around 7%, in order to be taxed on that money more by the IRS. The lowest rate in the United States still remains at around 10%, while the highest rate is around 37%. And of course, this is all for single filers. Now, I'm going to throw a chart here up on the screen that compares the 2022 income tax brackets to 2023. So let's dive into it. Essentially, what you can see by this chart is that your income tax brackets from 2022 to 2023 are going up. So you have to earn more money, and then the IRS is going to take more money from you. That's how you're going to pay more in taxes. So basically, once you've made $10,275, then you're going to be taxed at 12% of all money over that amount. However, in 2023, that number is increasing to $11,000. So you won't actually be taxed at the 12% rate until you have made $11,000. So what this is going to mean for the vast majority of Americans is that you are going to get to keep a whole lot more money before it gets sucked away in taxes. Now let's move on to the capital gains tax. So the capital gains tax is actually increasing by 7% as well. So single filers who made under $41,000 in 2022 this year won't really have to pay any capital gains taxes on their investments, but that number is actually increasing to over $44,000 in 2023. That's around a 7% increase. Now, of course, if you make above that $44,000 mark, you're going to have to pay around 15% in your capital gains in 2023, and that number is pretty much what most people are going to pay because the highest you can pay is 20%, but that doesn't kick in unless you make around $492,000 plus in income every year. So most people are going to pay that 15% mark, and that kicks in just over $44,000. One of the bigger tax changes that the IRS is making is to the estate tax. So for people who pass away and they have an estate or they have a lot of other assets that they're going to give to the next generation or to another family member, that amount that is going to be able to be taxed is being increased in 2023. So in 2022, it was around 12 million, but now it's around 13 million, an increase of just over 7%. So the bottom line here is that you won't be taxed on your estate if it remains under around $12.9 million. And Americans can give out way bigger financial gifts in 2023 by about $1,000. If you give away money of around $17,000, you're not going to have to report that or pay any taxes on that as long as it's reported as an actual gift. So you're giving it to somebody for them to use for something else. All right, so I know that was a lot.
I'll say, yeah.
So basically what you need to take away from the IRS making these tax changes is that the IRS is increasing their limits on what you can be taxed on. That means you're going to have to meet new thresholds in order to be taxed on that money. You're going to have to make more in order to be taxed on your capital gains. You're going to have to make more from your income in order to be taxed on that as well. Same thing with the estate taxes and same thing with special gifts. And what you're probably wondering is, well, why? Why exactly is the IRS increasing its tax brackets right now? Why exactly is it increasing its limits? I mean, doesn't it want to get taxpayer money? Well, of course, but the reason the IRS is increasing its tax limits right now has to do with inflation. inflation. Inflation over the last year is around 8.2%, the highest that we have seen in over 40 years. This means that if the IRS left the tax brackets at what they were at, then people would be losing a bunch of money because now they're going to be putting a whole lot more money into other things. So the IRS is actually increasing their tax brackets so that way people can save a little bit more money. Basically, over the last year or two, many Americans have been forced to spend a lot more of their money on a lot of other things, and many of them have gotten something called a cost of living wage increase at their job, and that simply means that an employer has to shell out more money so that its workforce can actually go out and afford to buy things. But what you've got to keep in mind here is that this will sometimes push people into a higher tax bracket, meaning that they're going to owe the IRS a whole lot more. That eats away at their income, and it eats away at the amount that they can pour back into the economy, even though their total standard of living hasn't really changed. They're making a whole lot more money, but that's only just to keep up with inflation in 2022, and the IRS believes that inflation is still going to be a problem, so they're actually increasing their brackets so that way people don't get hit as hard. Now let's go ahead and talk a little bit about what this means. So the IRS obviously raising its income tax brackets and a lot of its other tax brackets means that it's immediately not going to be receiving as much tax money, because even though people have gotten raises over the last couple of years, they're not going to be in those new tax brackets, so they're going to be paying a lot less taxes even though they may have gotten a raise over the last couple of years. On one hand, that is going to be really good for the individual, right? Because now people are going to have a whole lot more money to pump back into our economy. They're going to be able to buy a lot of things that they need, and they're not going to have to worry as much about putting that money away for taxes. They are essentially going to get to keep a lot more of their money at the end of the day, and that is good for just about everyone when inflation is high. That gives you a little bit more buying power with your dollars simply because you have more of them. Now, from a microeconomic standpoint, this allows Americans to save more, and it allows Americans to invest more, and it allows Americans to spend more. And if Americans really need to buy things right now and the price of things continues to go up, this is a much needed help for many of them. But on a macroeconomics level, this could mean that inflation does kind of stay a little bit elevated for an extended period of time. You've got to think about why we have inflation in the first place in our economy. I mean, with the pandemic kind of at the start of all of this, Americans were out of work for a long time, and that led to a lot of supply chain issues, and it led to the federal government and the Federal Reserve printing a lot of money for Wall Street and in stimulus checks for just about everyone. So a lot of Americans got a ton of money all at once, but that meant that spending also went up a lot because, granted, many Americans needed this money in order to stay afloat. There was a good chunk of Americans, though, that did not need this extra cash. They were still employed, they were making really good money, and they were getting stimulus checks anyway, thousands of dollars, and they went out and spent that money. So that kind of really contributed to inflation a lot, and that meant that our supply chain issues got even worse. And now in 2022, because of a lot of economic problems from across the world, price gouging from some corporations, and continued supply and demand issues, well, now we have a really big issue with inflation. But what you kind of have to ask yourself is, what is a bigger proponent of inflation? Is it that we don't have enough supply, or is it because we have too much demand? I think that right now corporations and businesses are working on the supply side, but they have to be really careful here because they don't want to have too much supply, or else they're going to run into a problem like Walmart and Target are having, where they have too much inventory and now they have to put out huge sales in order to get rid of it. That hurts their bottom line and it hurts their overall business. So businesses don't want to have too much inventory, so they're kind of being very careful with what they anticipate demand is going to be like in the future. And if you look at the demand side, well, there has been a lot of demand over the last couple of years, especially in 2021, as more people kind of switch jobs because of the Great Resignation. Many of them are now making a whole lot more money, and stimulus programs over the last couple of years, investing boomed over the last couple of years. All of your stock market indices actually grew to a new record high in 2021. So there has just been a whole lot of money circulating around, and that has meant an excess of spending in the United States. I think that is one of the biggest and key issues with our inflation problem of today, something that eventually will improve as supply kind of comes up and as the Federal Reserve continues to raise its interest rates quickly and aggressively. Maybe not in the ways that they want it to, maybe not in the ways that they needed to, but that's probably what's going to happen. But with the IRS kind of making these new tax changes, people are going to have a whole lot more money. People that now are probably going to go out and spend this money. And again, the people that absolutely need this, well, this is going to be great news because now they're going to be able to go out and buy more groceries or spend more money on energy, things that they absolutely need in order to have a sustainable life. But the fact of the matter is there's going to be a good amount of individuals that are going to see this as a tax break and are now going to go out and spend this money, probably in ways that they don't need to, in ways that kind of contribute to inflation, because now they're going to overspend because they have more cash, and that's going to signal to businesses that demand is a whole lot higher, even though it's coming from certain individuals, and that's going to hurt the individuals that are getting these tax breaks and actually need these tax breaks to begin with. Now, is this going to raise inflation by 2 or 3%? I absolutely do not believe that. I think inflation is eventually going to come down, like I said before, with the interest rate hikes and supply starting to rise in the United States. But it could mean just more problems for our inflation issue, and it could mean that inflation just kind of sticks around and stays really stubborn for the extended future. And the other thing you got to consider here is the IRS is now not going to be getting as much tax revenue. So now the federal government and your state governments aren't going to be getting as much revenue, and things are starting to cost a whole lot more for them, meaning we could start to see from the federal government and the state level a bigger budget deficit because they don't have as much money to collect in taxes. They've got to fund a lot of their projects and they've got to get this money from somewhere. This could cause the Federal Reserve to restart that money printer. They could have to start printing more money or pulling money from other programs in order to fund the things that they absolutely need to in 2023 because they're not getting as much tax revenue. You got to remember the federal government doesn't really get any money on its own. It doesn't have a product. It doesn't sell anything. So the only way that it can get revenue to fund this country is through taxes. And at the end of the day, we have seen the Biden administration start to get really creative with their tax ideas on just about everything under the sun. They're going to figure out a new way to tax you and to try to get as much money as they can to fund their bills. So while you might be saving some money in your direct income taxes or through the estate tax or your capital gains tax, there could be some other taxes added on to everyday Americans over the next year and a half. This is something that has to be considered because the Biden administration has some very, very expensive bills that they need to pay for, like the recently passed Inflation Reduction Act and of course the infrastructure program that was passed in 2021. All of these things are hundreds of billions, if not trillions of dollars, and that money has got to come from somewhere. Like I said, the only way that that can be funded is through American taxpayers. So one way or another, you might be saving some money up front, but at the end of the day, the United States government is going to find a way to kind of recoup those tax dollars over time. So you've got to kind of be aware of all of these different things because this is not a time for you to go out and overspend or overexert yourself financially because some of that money might start to get eaten away over the next couple of years. You want to try to afford and stay within your means right now because if you don't, thinking that taxes are not going to go up, taxes are going to go down, well then that could end up being a problem for you in 2023 or beyond. So this is exactly why financial education and money management is extremely important, and that is exactly what we talk about on this channel 7 days a week. Because if you don't lead your money, it will definitely start leading you, and in this case, it's going to lead you right to the United States federal government and the IRS. But that is it for today's business and financial news breakdown. Thank you so much for watching. If you want to stay up to date with all the top business and financial news from around the country, our team puts together a free daily newsletter, and you can subscribe to it by clicking the link in this corner right here. And if you want to stay up to date with me and everything else happening in the business and financial world, I'm putting out updates 7 days a week over here on this channel, and I've actually got another one ready for you right here, so be sure to check that out before you go. That is it for me, everybody. Be kind out there, and I'll see you all in the next one.